60% of baby boomers are not financially ready to retire. A figure that is not based on headlines or blog posts. It comes from the Vanguard of one of the world's largest pension fund managers. This generation has worked for 40 years. This generation is repeating the same thing. Save a little money. Keep your head down, retire, fix your problems. Now, however, with the largest wave of retirement in American history rolling in, 11,400 Americans will live to 65 a day in 2025, most of whom will leave work, saving less than $122,000. Here is what that number actually tells you. At a responsible withdrawal rate, $120,000 a month generates about $400. Retirement should last 20 to 30 years, not 4. So it is worth watching in real time how an entire generation has become the wealthiest generation in history in terms of accumulating wealth, eventually exposing it financially. Because it is not a story of laziness or bad luck, and not exactly. It is a system that changes the rules halfway through the game, punishing those who made decisions that seemed perfectly sensible at the time, and now accumulating decades of delays. If you are 45 to 65 now, the disturbing truth is that the story may already be yours. Start with what Fidelity actually found when it calculated data on baby boomer retirement accounts. The average 401k balance for baby boomers is $249,900, and the average ERA balance plus $257,700. In theory, that sounds feasible. With the 4% rule, the standard financial planning benchmark, in which you can safely withdraw 4% of your savings a year without having to burn your principal in 30 years. The calculation quickly collapsed. $250,000 or $10,000 a year at 4% or $83 a month before tax. The gap between what people own and the actual cost of retirement is at the root of a crisis. In this crisis, Americans need an average of $46,000 to $57,000 a year to maintain a basic standard of living at retirement. Worse is the difference between the average and the median. That average has been lifted by the wealthiest baby boomers at the top of the distribution, making the situation seem more manageable than it really is. When Mr. Nathix's investment managers looked at the median, they found just $122,000. This is the person sitting in the middle of the baby boomers, not the struggling outsider, the real center of this generation. Fidelity released a figure in its healthcare cost estimates for retirees 2025, $120,000 to fund 30 years of retirement, during which one person's healthcare costs alone will cost $17.25. Healthcare alone exceeds the median retirement savings of an entire generation. In any case, the waves kept coming. According to the Alliance for Life Income, the number of 65-year-olds in the United States was 41 million in 2025, the absolute peak of what researchers call peak 65, which lasted from 2024 to 2027. Nothing in retirement history is comparable to its current size, nor can it be underfunded. Allianz Life's 2025 retirement study found that 64% of Americans said they were more afraid of running out of money than dying. Fear of poverty is better than death. It is not an abstract financial anxiety. It is millions of people who have done math and understand numbers. Understanding how baby boomers ended here goes back to the 1950s and 60s, when America's retirement system actually operated the way most people still think. Workers at large corporations, steel mills, automakers, government agencies receive so-called fixed income pensions, which means companies promise to pay a certain monthly lifetime wage, no matter what the market does or how long workers live. The risk is entirely borne by the company. Nearly 2/3 of American workers born in the 1920s and 1930s are baby boomer parents who receive some form of sponsorship. Then, in 1978, a tax lawyer named Ted Benner discovered something. In that year's Income Act, a chapter called 401, originally written as a supplemental savings option for business executives. No one designed it to replace pensions. No one wrote this article to carry an entire generation of retirees. American business took a different view, and then everything changed. By the mid-1980s, the company had a simple calculation. The cost of running 401k was only a fraction of pension costs. And more importantly, it transferred all investment risk to employees. If the company is willing, it will contribute accordingly, and its obligations end there. With pensions, companies can absorb a bad market in a few years. With 401k, workers have it. Pensions did not disappear in a dramatic statement over the next 2 decades. They faded during the hiring freeze, planned shutdowns, and quiet transitions that most baby boomers experienced in the mid-negative 1990s. Baby boomers are transformative, the easiest part of the story to bury. They enter the workplace while their pensions are still there, build early careers around reasonable expectations of guaranteed income after retirement, and then quietly let that expectation disappear from their minds for half of their working lives. Those who replace pensions with 401ks also forget to mention that 401ks will have real effects only under very specific conditions. Decades of continuous contributions, interest rates high enough to have an impact, and the whole investment decision is quite reasonable. There are 4 conditions. According to one of the most detailed analyses of this group, the median baby boomers nearing retirement age ended up saving $134,000. Not enough to retire in 20 years, let alone 30. 401k is not sold as a gamble. The generation that inherited it used it as a guarantee. The space between the two is where this crisis was born. When you retire, timing is everything. And for millions of baby boomers, timing is almost entirely bad. This generation spans 1946 to 1964, meaning that the youngest baby boomers will reach retirement age in 2025 and 2026. Their incomes and savings peaked in the 1940s and 50s, when incomes were higher and household spending tended to fall, at a time of one of the most financially destructive periods in modern American history. In 2000, the internet bubble burst, and the typical heavy warehouse stock 401k halved by 60 to 70% in some cases. Workers in their 30s and early 40s, who were supposed to speed up donations, found themselves starting anew. From what was supposed to be a 10-year construction period to a 10-year recovery period, the recovery had only begun before 2008, with the financial crisis sending the S&P 500 down nearly 57%, from peak to trough, and the unemployment rate climbing to 10%. Millions of baby boomers in their 40s and early 50s face a choice: keep their savings unchanged and their families running. Many chose the family. Early 401k withdrawals, with a 10% fine on top of ordinary income tax, meant that people who withdrew money in a crisis would lose 30 or 40 cents for every dollar they withdrew, and would not return when the market recovered. They left. Then, in 2020, millions of older workers were squeezed out of the workforce, some out of choice, most out of the environment. At the top of the age bracket, layoffs are more intense. Many of those who left in 2020 and 2021 could no longer find similar jobs, and what they called retirement was an early exit for many of them, meaning years of lost contributions and withdrawals years earlier than planned. Inflation soared in 2021, peaking at 9.1% in June 2022, the highest level in 40 years, while the stock market sold 20% in the same calendar year. For anyone about to retire, the combination of rising prices and falling portfolio values is the worst combination, which retirement researchers call earnings sequence risk, one of the least discussed and most destructive forces in personal finance. Here is how this works in practice. When a market crash hits early in retirement, and a person is already selling assets to cover the cost of living, the losses become permanent. The portfolio never fully recovered, because the shares sold at the bottom were never repurchased. The market may climb back to full value, but the personal account will not, because it has been spent. The time lost is more important than the total size. And for millions of baby boomers, it is repeating itself at its worst time in 30 years. Many people have an obvious view. What about Social Security? The average monthly benefit in 2025 is about $1,907, and the cost of living in 2026 is adjusted to 2.8%, which sounds like a self-sustaining plan. The question is how to calculate that adjustment. Social Security is adjusted according to the Consumer Price Index, CPI, Durban working class residents. But retirees don't spend as much as urban workers. According to NAPANet's 2026 study, healthcare accounts for a much larger share of retiree budgets, and healthcare inflation is more than twice the broad price index. As a result, the annual Social Security adjustment is aimed at a cost basket, and retirees are actually paying for a completely different and more expensive basket. The gap has widened year by year, and the increase cannot keep up, and areas not covered by Medicare. Fidelity's 2025 retiree medical cost estimate shows that a 65-year-old retiree spends $1,725 to $2,500 on out-of-pocket medical care during retirement, copay dentistry, vision, hearing aids, long-term care. Prescription drugs beyond Part D limits are not covered, and the $172,200 bill is more expensive than anything else. It exceeds the median retirement savings of baby boomers. None of this touches on the long-term structural problems of Social Security itself, which are the most noteworthy and least concerned. The 2025 Social Security Trustee Report predicts that the Consolidated Trust Fund will dry up around 2033. The Congressional Budget Office made a more recent forecast in its February 2026 USA Today report, moving the date forward to 2032, a year earlier than previously expected. If Congress does not act before the end of its term, benefits will automatically be cut by about 28%. Specifically, the 65-year-old who retires today will be 72 by 2032. Those in their early 70s, who rely heavily on Social Security, will face cuts of nearly a third of their main source of income, at a time when healthcare and living costs are rising at their fastest pace. Fortune reported in April 2026 that a 28% interest rate cut would reduce the monthly benefits of ordinary retired workers from about $27.1 to $144.1, with a monthly loss of nearly $600. Studies related to the peak 65 wave show that about a third of baby boomers born in the early 1960s will rely on Social Security for at least 90% of their retirement income by age 70. If benefits shrink, 90% of dependents have little cushion, and trusts now set for 2032 have 6 years to run out. In addition to systemic failures, 3 specific financial traps have seized on a large number of baby boomers, none of them with the warning labels they deserve. The first is real estate as a retirement strategy. Baby boomers have more housing stock in the United States than any generation before them, and a large part of this group has retirement plans around the assumption that homes will eventually take care of them. That logic lasted decades. Prices generally rose. You buy a house in your 30s, pay off your mortgage in your 50s, and plan to downsize, pocket profits, or use equity when needed. The trap is that the house is not liquid. You can't use your bedroom to pay for healthcare, and cutting costs won't release as much money as people expect, especially when the homes they move into also appreciate. When transaction costs consume 8 to 10% of sales, and when selling cash still needs to finance decades of living expenses. Real estate wealth is real wealth, but converting it into reliable monthly income requires a specific written plan rather than vague assumptions about sales on a given day. The second trap is the so-called parent bank, a model in which baby boomers provide financial support to their adult children before their 20s and 30s, covering student loan payments, down payments, and absorbing living expenses. The instinct behind it is generosity. Financial math is ruthless. Every dollar withdrawn from the retirement account, or never contributed from the beginning, is used to support adult children in their 20s, spending $50 or $6 from the retirement account, as savings delay each year and the window for recovery shrinks. Baby boomers, who put their children's financial lives ahead of themselves, tend to do so in the exact years when their contributions should have the greatest compounding effect. The third trap is underestimating the actual number of years of retirement, which does the least damage. Americans 65 or older now have an average life expectancy of about 84 for men and 87 for women. A significant portion of this group will turn 90. For many who are still alive, retirement will last 25 to 30 years. Most baby boomers plan to shorten their time. They use shorter maturities to calculate how much money they need to save and retire earlier than math can support. And these longer lives are now offsetting the savings pool, calculated for shorter lives, while inflation erodes purchasing power and healthcare costs become complex in the final stages of retirement, during which time money has reached its lowest level. Something began to appear in the labor market data in 2025 and accelerated to 2026, telling the whole story in a single trend. Millions of retirees are returning. The return of baby boomers to the labor market has pushed the average age of the US labor force from 45 in 2022 to over 42 at the end of 2025. The Independent reported the rise in the average age of the entire American workforce over 3 years and 2 years reflects a large number of people changing retirement decisions, most of them driven by financial pressures. The Trans-American Center study found that 57% of baby boomers now plan to retire at age 70 or older, with some saying they do not plan to retire at all. More than half of this generation plans to work into their 70s, not because they find meaning in their jobs, though some do, but because the monthly numbers don't end without pay. Healthy inflation is the single biggest driver of this reversal. According to NAPANET Research 2026, the gap between fixed income and fixed expenditure automatically widens every year as healthcare costs rise at more than twice the rate of Social Security adjustment. The only way to close the gap is to make more money, spend less, or withdraw savings faster than the plan allows. And most people can only maintain the third option for so long before returning to the first option. Pioneer's difficult withdrawal data confirm the same pressure from different angles. In 2025, 6% of 401k participants were difficult to exit, the sixth consecutive annual increase, and 3 times as much as before the epidemic. They are truly in financial trouble, trading future earnings for current survival 3 times faster than before the coronavirus arrived and changed everything. The 6 chapters on why things went wrong are now really important. To anyone watching this article, if you are in any window between 45 and 65, the most dangerous thing you can do with this information is assume you're fine because your 401k scale looks good on paper. The average seems manageable. The median is half. Neither figure takes into account healthcare costs, the impact of 25 years of inflation on purchasing power, or your actual lifespan. To make honest predictions, use a fee-only trust advisor, rather than someone who sells products. A trustee required by law to act for your benefit, and obtain the true numbers on paper before you need them. For people 5 to 10 years from retirement, income sequence risk is the biggest hidden danger. In the 5 years before and after the shutdown, how the portfolio is allocated is more important than almost any other financial variable. And even if everything else is done right, an untimely market crash in this window will permanently damage retirement. The answer is the downside strategy. As the retirement date approaches, gradually adjust the risk profile of the portfolio. Do not turn to all cash too early, and do not hold all equity for too long. Social Security timing matters more than most people think. Delaying applications beyond the full retirement age, 67 for those born after 1960, increases benefits by about 8% a month in each year until age 70. Guaranteed annual growth of 8%, inflation adjusted, and zero market risk. This is one of the highest returns and lowest risks still available in the current system for anyone in reasonable health. If net worth represents most of your financial assets, the final downsizing plan needs to be a specific written strategy with real numbers attached. Transaction costs, moving costs, where you will live in the future, timelines related to your health and mobility, all need to be worked out before money is needed, not in an emergency. If you've been supporting adult children financially while postponing retirement savings, this conversation is needed now. Retirement accounts at ages 7 and 5 are exhausted and cannot be rebuilt. Adult children are far ahead in their entire money-making lives. For people in their 50s, the compound interest window closes over time, not reopens. That is it, not baby boomers. The baby boomer retirement crisis is real. The pension collapse is real. 401k gambling is real. To be sure, the Social Security clock now counts down to the projected depletion date of 2032. And the 28% benefit cut confirmed by the Congressional Budget Office. None of this is speculation. All of this is documented. But it is not just a generational lesson. It is a sit-in. Failed boomers are still running the same system. Next came Gen X. Millennials have joined. Decisions over the next decade. Congressional decisions on Social Security. Employers' decisions on matching contributions. And individuals' decisions on how much and when to save will determine whether this will happen again more broadly. Baby boomers don't come here because they don't work hard, or because they don't care much about their future. They ended up here because they got a system built on corporate cost-cutting, political short-term, and a convenient fiction that every American would naturally become a disciplined, lifelong investor without any real training, meaningful support, or effective safety net behind it. Today, fiction plunges 418,000 times a year. Those on the other side of what is coming are those who stop waiting for the system to protect them and start building what it can't take away. Not because the system has improved, because they don't think so anymore. If someone in your life needs to hear this, but may not be looking for it, send it to them. If you want more, subscribe. See you next time.